that's for me and not for Dorf. Good afternoon, everyone, and thank you for the opportunity and thank you for the introduction, Dorf. If you take a look across a typical business value chain, it is very encouraging that the South African government has introduced a competitive mix of tax incentives as well as cash grant opportunities for businesses. I'm not going to go into the detail. Dwayne will go into the detail at the next presentation, but generally incentives can be categorized into 5 main categories, being research and development, improved competitiveness, job creation, energy efficiency, and the promotion of capital investment projects. A general comment from my side is that our current incentive regime is in line with various government policy initiatives and aligned to key objectives such as economic growth targets, addressing electricity supply constraints, and addressing high unemployment numbers. A further observation is that there is a mix of generic incentive programs that are not necessarily targeted specific industry sectors, but there are also some more generic type of incentives, such as the Section 11D tax incentives, the Section 12L energy efficiency tax incentive, and the manufacturing competitiveness enhancement program. Sorry, that was the next slide. If we look at industry-specific incentive, and I want to spend a bit of time on this, because there's a mix of incentives, for example, that supports the automotive industry, the clothing and textile industry, the film industry, the aquaculture industry, as well as business process services. And in our experience, the more focused industry-specific type incentives achieve specific industry objectives due to a coordinated effort from private sector, industry body associations, government departments, and various other related stakeholders, and I'll touch on that a bit more in our recommendations. Countries compete globally to attract investment projects. It's not something specific to South Africa, and there is very limited information available from a grants and tax incentives comparison point of view in order to benchmark different countries against each other. If you have to compare it to different countries use different incentive mechanisms, such as tax allowances, tax incentives, regional incentives, discretionary cash grants, as Dov touched on previously. And to compare all of that and to get an apple-to-apple comparison is quite difficult and challenging. In an attempt to benchmark the South African tax incentives, the Davis Tax Commission approached the World Bank Group in 2014 to update an earlier study that was conducted in 2006 to assess the performance of the South African tax system, including tax incentives, to other global counterparts. Part 1 of the report was published in June 2015, and the report is titled The Sector Study of Effective Tax Burden and Effectiveness of Investment Incentives in South Africa. And there were some interesting findings. The methodology that was used was to analyze the marginal effective tax rate for various sectors in South Africa. And I guess the marginal effective tax rate effectively measures the gap between the before tax rate of return and the after tax rate of return on investments. The main conclusion from the report was that from a general point of view, the South African marginal effective tax rate is internationally competitive. I think that's something that was also covered on the first day of the Indaba. Across all sectors but one, the marginal effective tax rate on capital is lower than the corporate income tax rate of 28%. And that is mainly due to mechanisms such as accelerated depreciation allowances, investment allowances, and the deductibility of interest that reduces the effective tax burden on investors. The study team was specifically also tasked to look and to benchmark the South African manufacturing industry, and it was found that South Africa ranks 58th out of 95 countries.